Let's talk about automated trading in 2026. Because if you spend any time around investing content online, you'll hear two extreme opinions. One side says automation is the inevitable future of investing. The other side says it's all hype and everything eventually blows up. The truth? Both sides are missing something. Automated trading can be incredibly powerful, but only when you understand what it actually does, how it's built, and where it belongs inside a real portfolio. So in this video, I'm going to walk you through automated trading the right way. No hype, no fairy tales, and no pretending risk doesn't exist. Most investors don't fail because they're bad with money. They fail because they're human. They get emotional. They hesitate when they should act. They overreact when markets move fast. And if you're a working professional, there's another problem: time. You don't have hours every day to analyze charts, manage entries and exits, and babysit risk. But you also don't want to blindly hand everything over to someone else and just hope they do the right thing. That tension between control, time, and discipline is exactly the gap automated trading is designed to fill. Let's clear up the biggest misconception right away. Automated trading is not a magic machine that prints money forever. What it really is a rules-based execution engine. Instead of a human clicking buy and sell based on fear or excitement, the system follows predefined logic. When specific conditions are met, it enters. When risk limits are hit, it exits. When there's no opportunity, it stays in cash. The edge isn't fortune telling. The edge is discipline and consistency. The system does the same thing every time, whether markets are calm, choppy, or outright chaotic. Here's where most people get burned. They assume one strategy will work forever. They chase whatever just had a big winning streak. They crank up position size too quickly. They treat automation like a replacement for their entire portfolio. But markets don't work that way. If you look at how professional trading firms operate, they're constantly adjusting. They monitor what's working and what's fading. They cut or reduce strategies that stop performing. They introduce new ones to adapt to changing conditions. Any automated system that never evolves is eventually going to fail. That's not negativity, that's history. One of the biggest differences between professional-grade automation and retail hype is structure and control. In properly designed setups, investors use their own regulated brokerage accounts. That means capital stays in the investor's name. The investor maintains direct control of their funds. Nothing is sent away or parked in a mysterious third-party wallet. The automation runs through permissioned technology that can place trades inside the account, but cannot move or withdraw funds. So execution is automated. Control and transparency stay exactly where they should be, with you, the investor. Another thing people almost never think about: what markets the automated system is actually trading. Not all markets are created equal. Low liquidity assets are easier to push around. Thin markets can spike or crash on very little volume. Some instruments react violently to a single headline. That's why professional systems tend to focus on deep, liquid markets, places where massive volume helps reduce random price shocks and allows strategies to scale more responsibly. Liquidity isn't flashy, but it's one of the biggest drivers of long-term survivability. Here's an uncomfortable truth most investors don't love hearing: risk management matters more than headline returns. Anyone can size up wildly, get lucky once, and show an amazing month. Very few can do it repeatedly without eventually blowing up. Professional systems are built with defined position sizing, preset drawdown limits, protective controls baked in from day one, not as an optional toggle, not as something you add later if needed. The goal isn't to avoid losses forever. That's impossible. The goal is to survive losses and recover in a controlled way. This is where expectations really matter. Automated trading works best as part of a portfolio, not the whole thing. The most successful users usually already own other investments like stocks, real estate, or long-term funds, want something that behaves differently from their core holdings, are looking for diversification and uncorrelated return streams. They start with a sensible allocation. They watch how it behaves in different market environments, and if it fits, they increase exposure gradually, not emotionally. Automation rewards patience and process, not urgency and desperation. Another key point: this should never feel like a black box. With properly structured automation, investors can log into their own brokerage account, see open positions and closed trades, track performance and drawdowns in real time. There's no mystery about what's going on. No "just trust us" required. Transparency isn't a nice to have, it's a non-negotiable. Let's be very clear and very honest. Automated trading involves risk. Drawdowns happen. Performance goes through strong periods and weaker periods. There are no guarantees. What automation offers is structure, discipline, and a way to apply probabilities consistently over time, not perfection. Used correctly, it removes emotional mistakes and enforces a repeatable process. Used incorrectly, it can simply automate bad decisions faster. The difference isn't the software. The difference is how the investor approaches it. So if you're someone who already has an investment portfolio, you care about transparency and staying in control, and you understand that risk can't be eliminated, only managed, then automated trading may be worth looking into. Not as a shortcut, not as a replacement for your primary income, but as a tool inside a broader long-term strategy. If you want to see how ATN
Automated Trading Network
with structure, risk awareness, and full transparency, check out the link in the description. It's there if you want to dig deeper. No pressure, just information so you can make up your own mind. And if you found this video helpful, make sure to subscribe to the channel and turn on notifications. That way, whenever we post a new video, you'll see it right away, and you'll stay informed so you can make smarter, more confident investing decisions over time. Thanks for watching, and I'll see you in the next one.